So our next speaker is Ashish Swarup from Aikya Investment Management, which he co-founded in 2020. Aikya is an independent, employee-owned investment management company that specializes in managing emerging markets, equity portfolios. And investing in emerging markets is the topic of Ashish's presentation today. Fundamental to Aikya's approach are the concepts of stewardship, resilience, and sustainability. These are words that are familiar to us all, but I believe Aikya's interpretation of these concepts are unparalleled in the investment industry, and I'm excited Ashish has joined us today to discuss them in more detail, along with the investment case for investing in emerging market equities. So over to you, Ashish.
We started this firm 2 years back, but our team has been investing in these markets for almost, 3 decades. So I'm here to share our experiences, but please feel free to stop me anytime. And I'm sure you're from an emerging market yourself, so you'll find a lot of things quite relatable. I think the first thing, just a few slides to outline why emerging markets are interesting places from an investing perspective. So this chart you've probably seen already. It just essentially outlines the convergence story. So a lot of these countries, basically, if you go back, let's say 500 years back, they were just all similar GDP per capita level. Then Western European countries and America sort of, pulled ahead in terms of prosperity level, while a lot of these countries just fallen behind. But now for last 20, 25 years, they're converging. Obviously, it's not a done deal. Not everybody is converging, but at least the major countries like China, India, Brazil, Indonesia are on a real convergence trend. On top of it, you also have a very favorable demographics. So, Japan, you can see it is a basket case almost, but even the other Western countries like UK and US are much worse in terms of demographics versus some of these emerging countries. And then so you have these sort of very rosy predictions. This is just one of the predictions where, let's say in 2030, out of top 10 majority of these countries will be, from this universe. Of course, not 100% of this is going to be correct. You can see some countries like Russia here, which may not actually turn out to be true. But the broad point is that the big countries like China, India, Indonesia will actually be there and be important enough not to ignore. This is all very just the summary of the positive case. And this, I'm sure you've sort of read about it and heard about it in a lot of marketing presentations. But the problem, obviously, this is that this doesn't translate into actual investment returns. There could be a lot of economic growth, but when we talk about actual returns, then the returns are actually not very good for the last 5, 10, 15 years in these markets. And one of the issues here is we think it's is significant amount of corruption. So the lack of rule of law, lack of good institutions, and here just this chart just shows you the number of people, share of people who have bribed versus the corruption perception index, and the countries on the left are actually most of the emerging markets. On the right, the developed countries. What it leads really is just a few points. A problem of investing in these countries, which is, coming again from South Africa, you're very familiar with, political cronyism, weak institutions, and sort of deteriorating in general the rule of law, and again, dominance of state-owned enterprise, which makes things quite difficult. What it actually then translated to, sorry to go jump, but this is basically so if you go back any time of the year, the MSCI emerging market returns have been extremely sort of mediocre. So even last 20 years, it just barely matched MSCI World benchmark returns, or actually S&P has done better than that. So you can actually ask, then, so how do you match these two points where, long term you have a very good economic prospects, and the growth is much higher than a developed world, but it doesn't really translate into investment returns. So what I think, in our view, these are the reasons. So what you have is a situation where there's a lot of GDP being added, but there's very little wealth being created in these countries. And we think the reason is really these reasons where you have more and more state capture or more and more what you call corruption and so on. So there's scope for private entrepreneurs to create wealth and share it with minority shareholders is obviously is challenged. So what we think there are certain rules you can follow in these markets because the economic growth is real and you can actually benefit from that if you follow in our view, a disciplined investment approach. The first rule in our view is downside protection. So because these markets are quite volatile and could actually have a significant drawdown. So first rule is really to protect the downside. And there's just a simple sort of maths here where it shows that if you have a portfolio which is less volatile, it actually compounds at a higher rate because the geometric returns which investors experience and not just the arithmetic returns. That's the first rule we follow. But then the second, the problem there is that you can protect downside, but ultimately what we're interested in is long-term compounding of returns. And that's when I think these points become extremely valuable. So you not just protect downside, but also you think about how the long-term compounding works. So that's again, few points we follow in our approach. And I'll take you through each one of these points and why these are important and illustrated through a few examples. I think the most important thing here is to realize is that things about sustainability or talk about stewardship, these are not nice concepts in emerging markets. They are actually must-have in any investment approach because these can just break or make an investment case. So what really we're talking about here, I mean, what really we think about, how do we invest and what type of companies we're looking for. So if you think of any company, let's think of, let's say, ShopRite, for example. You can think about a company from 3 different lenses. You can think about how good are the financials of ShopRite, what's the balance sheet, earnings, cash flows may look like. You can think about how good is the franchise of ShopRite, who are the competitors, who are sort of the industry structure is, what you sort of, how the industry looks like. Or you can think about who are the key decision makers behind ShopRite, who are, Christopher Weiss or who are sort of CEO or whoever is the decision maker. And that's sort of, we think in emerging markets, it's a lot more important to focus on who are the main decision makers, who are the what you call stewards behind the business than the business itself. Business itself is actually important, but what is really important is who are the people running the business. And that's very emerging market specific concept because in developed world, good quality businesses are usually run by good quality people. So let's say Apple is a good quality business run by good quality people. But in emerging market, a lot of times, because of corruption, because of lack of rule of law, because of political cronyism, what you have a situation where the good quality businesses are not really good because they're genuinely good, but because they're good because they're run by political cronies, or they could be run by corrupt people who are better at bribing. And the problem in investing in those businesses is that if the winds or the political regime shifts, or if let's say the company you're investing in is run by president's son-in-law, and the president sort of, son-in-law loses favor with the president, then you start losing a lot of money very quickly. So what you think is the stewardship, which is analyzing and making sure that the quality of people behind the business is good, is really, really important. So this is essentially a longer sort of checklist which we sort of go through. And stewardship is not just about the people. So the first thing we try to test is that what is the purpose of a company? And that's, again, quite important in these markets where there is very little what you call long-term regulation or sort of checks on and balances against what governments can do. So if your business is not really relevant to what the country wants to achieve, then it's subject to all kinds of expropriation risk or regulation risk in the government. Think about, let's say, a casino. If you are running a casino which is not very helpful to the country, then it becomes a very easy cash cow for politicians to ask for bribes or ask for favors and whatnot. So we think we really test for that. So we really want a business which is actually contributing, because even for the worst type of politicians, they think twice before asking for money or asking for some sort of favors from business which are actually helping the people around them. Governance is second point, which is totally non-negotiable. So that's the easiest way to lose money in these markets, basically either backing a shareholder who's not very well aligned or backing a shareholder who's corrupt and takes your money. So that's part of the reason why the benchmark, emerging market benchmark, does not do well, because it's sort of full of companies which are either state-owned companies where you're not aligned with the state owner, or they're full of businessmen who are corrupt. Environmental social stewardship, again, is the same reason as is the purpose. Basically, you're trying to answer the question that the people you're backing, are they cutting corners? We think if they're cutting corners either on environmental side or social side by not paying full taxes, not being responsible, then they might be cutting corners elsewhere. They might be cutting corners in their accounting practices or dealing with you or with us as minorities. The culture, again, we spent quite a bit of time establishing that, trying to understand how is it a place to work, and is it a sort of winning culture? Because again, these markets are quite competitive. So you have multinationals, all kinds of companies competing against the companies we invest in, and trying to establish that whether this company can withstand, a globally sort of competitive environment. The quality of franchise, like I said, is obviously important. But from our perspective, what we are really interested in is the business resilient. Again, it's very emerging market sort of focused approach, because these countries, again, you probably appreciate, are very, very cyclical. They are a lot more cyclical than a typical developed market. So what you need is a business to withstand bad times. And if a business is able to withstand bad times, then it sort of survives long term and does well long term. So that's what we are trying to establish through several means. We're trying to test how the business did during bad cycles, how is it run, and is the competitive advantage gets better over time or not. The quality of financials, valuation, again, I think are important. Valuation actually is really important, because we if you overpay, or if you try to, especially in these markets, then it just harm the long-term returns, and it just staying disciplined is quite important. So if you have an approach like this, and then you end up with a long list of companies you don't want to buy, and I'll illustrate that through a few examples just to make it a bit more because otherwise could get a bit more abstract. But a few points here to highlight. I think the point around negative social utility is important, because if you invest in some of these companies like tobacco, defense, casinos, coal, are extremely prone to corruption, because they're just seen as politicians from easy way to make money, and they just use it that way. So as a minority, then you have huge amount of leakage, which you don't want to see. Things around misaligned management teams and poor governance is really rampant. So, and again, because of lack of rule of law, as minority, your rights are limited. So if I see something being wrong at, let's say, British BP or Shell, or let's say any developed market company, I can write a letter to the board, and it might get worked on. But if I see something wrong with a Korean conglomerate and write a letter, I might be denied a visa next time to Korea. So it's really, your rights are really limited. So you have to be very careful whom you're trying to back. And then opaque and aggressive accounts. Accounting standards are not really uniformly good. So you have to really be very careful. And if anything is aggressive or creative, or you just sort of think you should avoid. So I thought I'll take you through a few case studies just to illustrate the points I'm trying to make. I think the first thing is around state-owned enterprises and why we avoid them. From our perspective, it's just a classic case of principal agent problem, where the people who are running these companies, they are not really they don't really worry about, what shareholder feels like or what shareholder does long term, because they are bureaucrats. They are being paid a salary which doesn't go up and down. It's not linked to the performance of the company. So this is just an example. So these are two banks I thought were quite interesting comparison. So one is called Kotak Mahindra Bank on the left-hand side of the slide. It's a private sector bank in India, and it's run by the person whose name is Uday Kotak, whose name is on the board. Then the second bank is Punjab National Bank, which is like a state-owned bank. So in 2012, Punjab National Bank was almost 3 times the size of Kotak, in terms of market cap. It traded on 1 times book value, and let's say Kotak traded on like 3 times, again 3 times book value, because a much smaller bank in 2012. What really happened over the last 10 years is the Kotak book value compounded at 16%, while Punjab National Bank actually declined at 18% CAGR. Now, this is a valid question to ask, that in a country like India, where the GDP growth is around 7 to 8% a year, how can a bank actually decline its book value at that rate? And given it's actually very good banking market, it's got really good sort of market structure. Now, the problem here again is it's a state-owned ownership, Punjab National Bank. So any sort of major banking scandal over the last 10 years, all the crooks from liquor baron Vijay Mallya to Gupta brothers from South Africa, they all borrowed from Punjab National Bank. And you can, it's the easiest place to borrow because it's so corrupt. You give some money to the loan officers and you get the loans. And that's the reason the book value declined. 18% CAGR. Last 10 years has seen 5 different CEOs. And you can see the performance. So even though in 2012 you would have gotten the shares at 1 times book value, those shares actually have not made you any money, versus Kotak Mahindra Bank, where you paid 3 times book value in 2012, but they've actually made you a lot more money versus owning Punjab National Bank. And that's just, I've not really cherry-picked this example. If you compare the performance of any state-owned company in emerging market versus its private sector counterpart, it's a very similar comparison. If you pick Chinese state-owned banks or Russian or Brazilian resource companies and compare them against the private sector companies, that's the comparison you get. On the right-hand side, we just did this for in general universe. So there's a significant performance gap versus the private family-owned businesses versus state-owned companies. And that's really we focus on. So approach is to just think about only family-owned companies or owner-managed companies, because that's the easy way really to enhance the performance in this universe. But family ownership is not really enough. So you need to think about other factors. So like I said, the other main thing we look for is the purpose. And why is it so important is just, we thought, illustrated through this example where if the companies are not relevant, if they're not solving a problem for the country, they attract attention from politicians, and politicians tend to go after those companies. It could be explicit, like this happened here, but it could also be implicit, where they ask for bribes or favors. This is a case where Chinese education companies, where for a long time, these companies were seen as very high quality by a lot of investors. These are private tutoring businesses. So they offer private tutoring services online, offline, for anyone who can afford them, for just so that the kids can clear certain exams in China. When we thought about, okay, what's wrong with education? It obviously has a purpose, but when we thought about these companies, the answer was not very clear. Firstly, these are very expensive private tutoring services, which means most of the Chinese cannot afford them. And also, it sort of actually creates a gap between people who can afford them and who cannot. So it's increased the inequality in the country. When we actually also analyze these companies, it was very clear what they state as a purpose is very different to the actual purpose. So obviously, if you ask the management team, they'll say, oh, it's great. We're obviously solving the education problem in China. But when you actually see how they spend the money, you see they spend the money more and more on marketing, sales, and actually less and less on teacher salary or infrastructure in their classrooms. So it became very clear to us very quickly that these are just companies without a purpose, and we failed them on the quality test. For a long time, it was not a problem. But then there's another bigger picture issue here where China is quite bad in terms of fertility rates. It was designed like that for 20 years back when they restricted births per family, but now they want to solve the problem. They see it as a problem, so they want to increase the births per woman. But because the cost of parenting is so high, and partly driven by this, it is not easy. So suddenly you have a situation where the whole sector of companies are really working against the purpose of what the country wants, and that's really became an issue. And then, as you might know, 18 months back, Chinese government regulated against the whole sector. So a lot of times in these markets, just avoiding landmines like this becomes very, very important for preserving long-term returns. Alibaba is another example. Again, it's just seen as very high quality business for a really long time by a lot of investors. We actually wrote about it about, I think, 2.5, 3 years back, where we sort of laid it out that actually it is not the high quality that people think it is. So the first question we usually ask in these companies is that, is there an original sin? What was the original sort of the way the business was set up? Was it helped by politicians or helped by someone questionable? So let's say in case of Colombia, Peru, a lot of Latin American countries, a lot of the business families who seemed very clean today, if you go back 15, 20 years, they have dealings in drug or money laundering. So that becomes original sin. In Russia's case, as you might know, again, in 1995, a lot of businesses got privatized under questionable circumstances, and that's an original sin in Russia. In India's case, a lot of the businesses who, again, appear very successful today, they have original sin because they got this critical, crucial license because of their political connection. That becomes an original sin. Now, what's wrong with original sin, you might ask, because if you have a political connection, why not exploit it? But the problem is that political connections are never stable, so they keep shifting. So if, let's say, you were a favorite of president and the president shifts, then becomes a problem. So we tend to avoid companies. So here, Alibaba, the original sin was that Alibaba was originally propped up, or at least had major shareholder Shanghai faction of Communist Party, because that faction was in power for a while, from early 2000s to 2013 when Xi Jinping took over, and they got significant amount of favors. I mean, eBay against eBay. eBay was banned from launching payment service in China. A lot of favors. I mean, there's like a whole list of favors Alibaba got, and the way Alibaba had to pay it back was when Alibaba got IPO'd in 2014. They did a series of questionable M&A transactions to pay back to Shanghai faction. So if you look at a lot of M&As they did, they were questionable, like buying a Beijing movie studio, for example, because the owners of that studio were people from that faction of the party. So that's basically, that's a quid pro quo. So if you've got favors, then you have to sort of pay it back through lots of leakage. In there, this is a VIE structure they have, and it's quite complex and is plenty of scope to leak the cash flow out. So this is basically what happened here. So when Xi Jinping came to power, he was against the Shanghai faction, and he started tightening screws on Alibaba. And last 3-4 years, we are seeing the impact of that. So Alibaba's franchise, which was 60-70% market share with total dominance on payments in China, got challenged against new rules, and the whole sort of the franchise quality deteriorated because ultimately the political affiliations actually shifted. So we avoid that, because then it just, as an investor sitting in London or in developed countries, we are the last ones to know when the political shifts or political affiliation shifts actually happen. Steinhoff, again, you're probably quite familiar with this story. So we actually avoided that for a long time, and there are multiple sort of, I won't go into detail, just multiple red flags here, but one of the major red flags from our perspective was the tax rates, which Marcus Joost was sort of somehow managed to pay. So this is just actually from a Viceroy report where every company he bought paid around 30% tax rate, which is not surprising given SA corporate tax rate is 28%. But Steinhoff tax rate was never more than 15%. And you try to ask him the question or try to spend like weeks analyzing how they manage it and look at their annual report, it was never 100% clear. So when things like these happen, we just sort of avoid because we think, ask the question, if they're cutting corners towards certain stakeholders, in which case the government, where else are they cutting corners? And it was very clear then there's a lot of other questionable transactions around M&A, buying questionable assets, complex corporate structure. A lot of things then don't add up. So there's obviously there are a lot of negative examples, but then what do we, the type of companies we like or we invest in? This one example where it's a consumer company in India. And I just use one of the slides from their presentation where, since 1996, they compounded shareholder return at 24%. In Indian rupee terms, which in dollar terms turns out to be 18-19%, and the growth in earnings at the same rate, around 23%. And why is it so successful is because we think, so it's got a very clear purpose. What they're trying to do is trying to help personal care in India in a very affordable way. And also they work through the supply chain. So they're very strong in terms of helping the suppliers, which again helps their competitive advantage and sort of very virtuous cycle. It's founder driven, and this is what we tend to like, where so what the question we ask is that if something happens to the company, who feels the pain? As a shareholder, if we obviously feel the pain, but is there someone in the company who's feeling the pain? The question, do they have the soul in the game? So the founder's entire net worth obviously depends on this company. But more than that, because his entire self-worth or his sense of self-worth, what he stands for also depends on this company. And this is exactly the type of people we really like. They not only suffer financially if something goes wrong, but they also suffer emotionally if something goes wrong with this company. We also like a combination of founders and the professional management. So we like the combination where the founders or the owners sit on the board, they control the long-term capital allocation, while the professionals actually run the company. So because the professionals are usually much better in day-to-day operations than the owners, especially when the company is scaled up to a scale this company has. We like simple businesses, and we like usually companies that are just focusing one country. Again, going back to Steinhoff, one of the things which we didn't like is that operating in 20 different countries and so complex that it's very hard to understand what they actually do. And we like, generally large addressable market for just simple product selling to a lot of people. And I think the other point, which is generally underappreciated again, is resilience. So we really like the companies who have actually, proven their resilience through various bad times. So how they've done through bad times is one of the things we really look for. And if the companies has come out through a bad cycle with market share gains or with better competitive advantage, and this is basically what we really are looking for. Just to maybe stop there, just to very sum up, is really, I think the main point which I always try to emphasize to investors is that it's very clear. I mean, anybody who spends even 2 minutes looking at this, the emerging market economic opportunity is very clear, but it does not translate into investment success that easily. Because the emerging market benchmark is not a good quality benchmark, unlike S&P, which is actually full of good quality companies. And the reason behind that is lack of rule of law, corruption, cronyism, and all kinds of shady characters who run businesses in this universe. So you have to be extremely picky, extremely fussy in whom you choose to back. And if you actually do, back good quality people, good quality entrepreneurs, then the investment success comes with it. And I think the last point is the sustainability is not an optional point. In this not nice to have, it's actually must have. You need to ensure that there is a purpose, is very well governed, and they are actually taking care of all stakeholders. Thank you very much for your patience.